European stocks have jumped on the hope of a peace deal in Ukraine. US and Russian officials are meeting today in Saudi Arabia for talks on Ukraine, to which neither Ukrainians nor European officials have been invited. But the market is hopeful that a ceasefire could ease the pressure on energy prices and the euro. Josh Passmore is an investment director at Artemis. Josh, of course, at the full-scale Russian invasion 3 years ago, we saw that huge jump in energy prices with consequences for all of Europe. Do you think we should expect prices to come sharply back down in the event of a ceasefire?
Good morning. I would say yes, that the initial market reaction is probably likely to be just that. I think gas prices in particular probably will decline. I think there's a few other things to consider, though. The act of any supply actually coming back online from Russia is probably unlikely, given logistically quite challenging. And also, there's a lot of political issues around that, obviously, given the events of the last few years. So I think the initial reaction, yes, gas prices and energy prices could come down, and you might see a little bit of a reversal of that early 2022 trade. But there are still lots of uncertainties with regards to the terms of the peace deal. We may learn more this week from Saudi Arabia, who knows? So I think the outlook is still quite uncertain from that perspective.
We're definitely seeing a positive reaction, though, aren't we, in the currency markets where the euro has been recovering? What should we read into that? Does the market expect higher growth for Europe in the event of a ceasefire?
Yes, I think that's a fair point. It probably is likely to ease some of the pressure on the euro, which has been pretty weak recently. But as I said, I think lots of uncertainty around any terms of a peace deal. We can also maybe expect, given governments are likely going to have to spend more on defence going forward, we can talk about that a little bit more in a minute. That's probably going to stretch government balance sheets even more than they are stretched already. So that results in some currency pressure as well. So again, I would say that yes, you might see some relief in the short term, but the longer term implications still a bit unclear.
That was indeed going to be my next question. We have seen this big upside for defence stocks as the market prices in a big boost. But how are European governments going to pay for this? Are they going to make bond investors nervous?
It's a really interesting point. I think probably is the answer. Debt to GDP is as high as it's been in many, many years, if not all of history. And there are just a huge amount of different things for European governments and indeed governments around the world to pay for. Growing social and healthcare costs, inequality, climate change, and now defence, which is extremely expensive. So yes, I think it's pretty reasonable to see bond yields pressurized upwards from here, maybe also driving interest rates higher for longer. So no, I would agree. I think definitely some pressure on government debt from here.
On the stocks front, though, who's going to see the upside? Which defence companies will see the result of this big spending?
I think probably quite a few is the answer. And we've seen some very large share price moves over the last few days. Rheinmetall, which is Germany's largest defence company, up 14 yesterday. Yes, I think those shares have re-rated a lot over the last few years. But when you consider a market capitalization of 40 billion euros against an order backlog of 40 billion euros, which is over 5 years worth of last year's sales, the company themselves think that they can get to 30 to 40 billion in annual sales per year within the next 5 years. And you just think for a company that has such strong demand that is likely to grow over the next few years, 40 billion euros doesn't seem like a lot of market value to me.
Having said that then, do you think these defence giants can meet this capacity challenge of expanding manufacturing as much as European governments seem to want?
It's very challenging. It's a capital-intensive industry, and scaling up capacity in Europe, where defence has been completely deprioritised, if we're honest, over 20 to 30 years, is going to take time. And that's why you see a lot of these European defence majors with backlogs that are 5, 6, 7 years long. So I think the answer will be that, yes, there will be a concerted effort to try and scale up production, but this is not something that can be done quickly at all. And it will require lots of planning and government incentives.
That was Josh Passmore of Artemis. Don't forget, you can watch more videos on Reuters.com.